Hey everyone, today we're diving into a really important question for any business that holds inventory. Is it valued correctly? We're going to break down the specific Canadian accounting rules that make sure your balance sheet is telling the truth, not just a story you want to hear.
So, let's just get right to it. Is your inventory actually worth what you've got it down for in your books? I mean, you might have a warehouse stacked to the ceiling with products, but is the price you paid for them still what they're worth today? Getting this wrong can seriously mess things up and mislead everyone about the real health of your business. To stop that from happening, Canadian accounting, and it doesn't matter if you're using IFRS or ASPE, has what I like to call a golden rule. You can think of it as a rule of caution, one that's designed to keep financial statements totally grounded in reality.
And here it is. It's called the lower of cost or net realizable value, or LCNRV for short. The idea is actually pretty simple, but it's incredibly powerful. You take two numbers, what the item originally cost you, and its net realizable value. And on your books, you have to report whichever one is lower. This is so important because it prevents you from overstating how much your assets are worth.
So what in the world is this net realizable value? Well, think of it as the cold hard cash you actually expect to get from a sale. You start with what you think you can sell it for, and then you subtract any other costs you'll have to pay to get it sold. Things like shipping or maybe some final touches and packaging. It's the net amount you'll actually end up with.
Now, for the other side of that comparison, cost. And it's not just the sticker price. It's basically every necessary expense to get that item onto the shelf and ready to sell. So that includes the price you paid, of course, but also any shipping fees, import duties, and even the costs of turning it into a finished product. What's not included? Things like unusual amounts of wasted material, general office admin costs, or the cost of selling it. Those are kept separate.
Okay, so the theory is one thing, but let's see how this LCNRV rule actually works in the real world. We're going to walk through 3 scenarios that, believe me, businesses run into all the time.
First up, let's imagine your company is sailing along, and then bam, the market shifts. Maybe a new competitor shows up and undercuts your prices, or maybe tastes just change. Suddenly, the price you can sell your product for takes a nosedive. So let's put some numbers on that. Let's say your original cost for an item was $20, but now, because of that market shift, your net realizable value, what you'll actually pocket, has dropped to $19. So you compare the $20 cost to the $19 NRV. The rule says take the lower of the two, so your inventory now has to be valued at $19 per unit.
Now, a $1 difference might not sound like a huge deal, but if you have 100 of these units, that's a $100 loss. This gets recorded on your books as an inventory write-down, and that write-down hits your income statement as an expense, which means your profit for that period just went down.
All right, let's switch gears to a much happier situation. What if the market is booming? What happens when the value of your inventory is actually higher than what you paid for it? Okay, in this case, let's say your cost is $50 a unit. You do your homework and find out the NRV is now $52. So what do? Well, remember the rule, lower of cost or NRV. Since the cost of $50 is lower than the NRV of $52, the value on your books stays right where it is. And this is a perfect example of how conservative this accounting rule is. It stops you from getting ahead of yourself and overstating your assets, but it also doesn't let you record gains that you haven't actually earned yet just because the market went up. Your inventory stays on the books at its original cost. Simple as that.
And now for our last scenario, one that is unfortunately all too common. Some of your inventory gets damaged. Maybe you had a leaky pipe in the warehouse, or someone got a little too aggressive with the forklift. It happens. Let's say you've got a batch of jackets that cost you $80 each. After they get damaged, you figure you can probably still sell them, but only for about $70, and it's going to cost $5 in extra effort to sell each one. So your NRV has just plummeted to $65. You compare that to your original $80 cost, and you've gotten no choice. You have to value them at the lower amount, $65. And if you had 200 of those jackets get damaged, well, that $15 loss on each one adds up to a $3,000 write-down. Ouch. That is a direct, painful hit to your bottom line, all because of a little bad luck in this very fundamental accounting rule.
So, let's go back to that first scenario for a second. What if the market recovers after you've already written your inventory down? Can you reverse it? Well, in Canada, this is where things get interesting. The answer is, it depends. It depends on if your company is public or private, because there's a tale of 2 very different sets of rules here.
Okay, check this out. Under IFRS, which is what public companies use, you can reverse a previous write-down if the value bounces back. But, and this is a big but, you can only reverse it back up to what the original cost was, not higher. Now, under ASPE, which private companies use, it's a different story. A write-down is permanent. Once it's down, it stays down. You can't reverse it, even if the inventory becomes super valuable again. That's a huge difference to be aware of.
Whew, okay. We have gone through a lot here, from the basic definitions to some real-world examples. So let's just take a breath and boil it all down to the absolute must-remember key takeaways.
All right, here's the summary. First, you always have to compare your cost versus your net realizable value. Second, you report the lower of those two numbers on your financial statements. Third, anytime you have a write-down, it becomes an expense and reduces your profit. Fourth, don't forget that critical difference. IFRS lets you reverse write-downs, but ASPE does not. And finally, the whole point of this entire rule is to keep things conservative and prevent companies from overstating their assets and their profits.
So when you step back, you realize a simple rule like LCNRV is about so much more than just numbers on a page. It's actually a building block for something much bigger. Principles like this idea of being cautious and realistic, they create a shared, reliable language for business. It means that an investor can look at a company in Toronto or one in Tokyo and know they're both playing by similar conservative rules. And that shared understanding, that is the absolute bedrock of trust in our global economy.